your attendee ID number, followed by pound. If you do not know your attendee number, press pound to continue.
We'll get started in one moment. Good morning and welcome to BPA's end-of-year quarterly business review for 2021. I'm Joel Scruggs, Director of Communications. We appreciate you making time for this forum this morning. I realize many of you have joined us before, but for any newcomers, you should know this presentation is being recorded and shared via WebEx. The link to this meeting and other public-facing meetings are on our event calendar on our website. If you have any trouble accessing WebEx, you can find the slide deck at bpa.gov/go-to/QBR. That's bpa.gov/GOTO/QBR. We encourage you to submit your questions at any time during the presentation, and we will respond to them at the end. To submit a question, click the chat button on the upper right-hand side of your screen, input your question, and press send. Your questions will be sent to the BPA host. Today, our Administrator and CEO, John Hairston, will start us off with a state of the business, and then he and Acting Chief Financial Officer, Marcus Harris, will provide a summary of the agency's financial and operational performance. And with that, I'll hand it over to John for a look at our key performance indicators and key strategic initiatives. Good morning, John.
Hey, good morning, Joel, and thanks. And welcome, everyone. Today we have a lot to get through, but I'm happy to report that BPA concluded our fiscal year 2021 with positive results across the board. We faced our fair share of challenges, but along the way, we advanced all of our strategic goals while delivering the reliable power and transmission services that are so vital to the region's economy and quality of life. And I'm particularly proud to be able to share these results with you, but also just proud to be able to lead such a wonderful organization of true professionals that work hard to make sure that we're bringing value to not only to our customers, but to the region. To begin, we ended the year with one of the best safety performances on record. Not only was our incident frequency rate well below the ceiling, we met our goal for safety corrective actions. Now, this was the first year that we tracked this metric, and I'm encouraged by what this leading indicator says about our proactive safety culture. We also exceeded our expectations for the agency net revenues and met all of our other financial metrics, which Marcus will cover later. But I do want to highlight the fact that positive net revenues bolstered our financial reserves so much that the reserves distribution clause has triggered for power for approximately $14 million. Now, what does that mean? That means we have a decision to make about how we redistribute the RDC amount. Now, whether it's for rate relief or other purposes like paying off additional debt. As outlined in our financial reserves policy, I'll share my preliminary decision with you today, followed by a public comment period and final decision no later than December 15th. Now, based on our information that we've gathered by from our financial team, including the fact that all of our power financial metrics are trending in a positive direction, my preliminary decision is to apply the $14 million RDC amount to a power rate reduction in fiscal year 22. Now, like I said, Marcus will go over this in just a bit, and it will be discussed in greater detail at a technical workshop later today. So let's move on to the debt to asset ratio. And as you can see, we met the target, but we are on the higher end of our goal to achieve a ratio of between 75 to 85% by 2028. Now, debt service is still a large cost for our customers, and we need to maintain this downward trend by continuing to focus on strategic asset management and regional commitment to debt reduction. Now, that leads me to the topic of Treasury borrowing authority. Now, access to capital should not be an issue for BPA for the foreseeable future, thanks to the bipartisan infrastructure deal that was signed. This legislation that was signed into law November 15th increases our available borrowing authority by $10 billion from $7.7 billion to $17.7 billion. Now, this means that we will have flexibility and funding certainty to meet our near-term and future capital funding needs. But as I've said before, this does not mean that we can relax our focus on our long-term financial goals. We will continue to prioritize prudent debt management and sustainable capital funding practices. These are the focuses of our financial plan refresh, and I look forward to working with you all to make sure BPA is well positioned to maintain financial strength over the long term. Now, a couple of other highlights to note on this page include our reliability metric. Now, our operations were challenged this year by not only below average water, record-breaking weather and load events, and wildfires. Our performance in the face of these extreme events were just remarkable. So I'm grateful for the BPA workforce for persisting through all of this and persisting through this ongoing pandemic. And with that, I'll hand it over to Marcus for a little bit more on the financial statistics. Marcus?
Yep, thanks, John. Good morning, everyone. So I'm very glad to be here with you today to close out our fiscal year 21 and the BP20 rate period. I'm happy to report that we met all of our financial targets this year that John mentioned. So as a reminder, please recall that this year's agency IPR cost KPI is being measured against the 2-year rate period target as opposed to the annual rate case amount we've historically used. This is reflective of some of the extraordinary effects of the COVID-19 pandemic, which caused us to carry over budget from one fiscal year 2020 to fiscal year 21 in certain areas. A 2-year rate period target for IPR expense has allowed us to hold ourselves accountable to our BP20 rate case commitments. So I'll start our walkthrough of KPIs with our fiscal year 21 agency net revenue performance. You can see the key net revenue drivers in the waterfall chart on slide 7. As a reminder, red means the driver decreased the agency's net revenue performance, while green means the driver increased our net revenue performance. So the agency had very strong net revenue performance this fiscal year, driven by lower costs and higher revenues. The agency's rate case net revenue forecast and KPI target for fiscal year 21 is $38 million. That's the blue column on the far left. While our net revenue end of year result, the far right column, is $398 million. So let me walk you through the drivers of that increase. IPR expenses ended the year $35 million lower than rate case. This is due to lower costs from our generating partners than was assumed in the rate case because of COVID impacts. It also reflects lower renewable costs and power. Ending the year $35 million below rate case is an accomplishment worth noting. This is the 4th year that agency program costs have remained flat, including absorbing the effect of inflation. The challenge continues to increase to meet our strict cost targets now that we are in the 4th year of holding flat. And additionally, wage and supply chain related inflation have surged recently, but we have remained intently focused on our cost discipline internally, looking to where we can save, what we can do less of, and what we can stop doing altogether. Now, there are some program areas in transmission and IT that ran above rate case, but these overages were reduced by close cost management throughout the year. So moving to the next bar, depreciation, amortization, and accretion costs were $47 million lower than rate case. Similar to fiscal year 20, this is driven by lower non-federal asset balance, which is Energy Northwest, due to the timing of accounting changes versus what was reflected in the rate case. This was also driven in part by lower completed plant and service balances than originally forecast. Net interest expense was $163 million less than rate case. This is primarily due to realized gains from a shift in asset allocation of the Columbia Generating Station Decommissioning Trust Fund, as I discussed in the third quarter. So these gains were partially offset by higher expenses due to how certain Energy Northwest interest was treated in rates versus how it actually was accounted for. This resulted from changes in Energy Northwest accounting treatment and was non-cash in nature. So this delta between rate case and actual shows up in fiscal year 21, but we have addressed this disconnect for the BP20 rate period and beyond. Other expenses is the one area of downward pressure on net revenue performance this year. These costs exceeded rate case by $139 million. This is mainly due to higher power purchases from higher market prices and dry weather experienced throughout the year. So last, our end of year operating revenues came in $254 million higher than rate case, largely due to higher than expected trading floor revenues, which were driven by higher prices than forecast. So combining all these core variance drivers together gets you to our final agency net revenue result of $398 million for fiscal year 21. So let's move on to the IPR expense slide. As I mentioned earlier, looking at the 2-year rate period for IPR expenses has allowed us to hold ourselves accountable to BP20 rate case commitments. Power IPR expenses ended the rate period $107 million lower than the rate case. Transmission IPR expenses, on the other hand, came in $12 million higher than the rate case, which is roughly 1% over the rate period target. So collectively, at the agency level, we came in $95 million below our IPR expense target for the rate period. So now let's take a look at Power Services and how they ended the year. So I'm very happy to report that Power's total expenses were below rate case and revenues came in above rate case. So we continue to drive positive margins in Power, which supports a healthy bottom line and also increased cash reserves. So looking more closely, Power's fiscal year 21 expenses were $86 million less than our rate case projection. We had $47 million lower in IPR expense from lower spending at our generating partners, lower fish and wildlife spending, and lower post-retirement benefit costs. On the non-IPR expense side, costs are $39 million below rate case, primarily due to the new asset allocation for the Columbia Generating Station Trust Fund, which created a large realized gain. These gains were partially offset by additional power purchases due to higher prices than assumed in the rate case. So on the revenue side, Power did exceptionally well. Revenues came in above rate case, even though January through July runoff at the Dalles was 82.2 million acre feet compared to the 80 water year average of 102 million acre feet. The fiscal year 21 end of year revenues were $243 million higher than rate case due to trading floor sales with higher than expected market prices. So despite selling 39% less surplus average megawatts than we planned in the rate case, the weighted average net sales price was $20 higher than the rate case. This resulted in $309 million in secondary revenues above rate case, which was offset by lower composite revenues due to lower loads, resulting in Power revenues being a combined $243 million higher than the rate case. Few final notes on this. The slice true-up drove up revenues compared to rate case by approximately $3 million. This is primarily due to BC Hydro payments for the non-treaty storage and Libby. All this together results in net revenues of $398 million for the fiscal year for Power, which is $329 million better than our rate case projection. So now I'll move on to transmission financials on slide 10. So transmission's end of year total expenses came in $46 million lower than our rate case projection. The decrease is primarily driven by non-IPR costs, which are $59 million less than rate case, largely due to lower net interest expense. This is offset by higher transmission IPR costs, which came in at 12% or 2% above rate case for the year. Recall that our rate case budget was flat in real dollars relative to the prior rate period. So $12 million above rate case is within our financial plan goal to keep program costs at or below inflation. While cost-saving strategies implemented this year did yield results, they were outpaced by increasing costs. The cost pressures that I reported out at the Q3 QBR in August materialized and ended up close to the Q3 forecast. Price escalation for equipment and materials, longer lead times, and escalation in labor costs were the main drivers. We also experienced higher IT software, higher NERC WEC charges, higher property insurance premiums, and maintenance costs. Increases in software licensing, new cybersecurity requirements, and less capitalization of IT projects also added to this year's cost pressure. So now I'd like to call your attention to the transmission revenues, which came in $13 million lower than rate case. This is primarily driven by non-renewals and deferrals of point-to-point long-term reservations compared to rate case, lower short-term point-to-point revenues, a fiber contract that didn't renew, and a low number of wireless reimbursable projects. But with that being said, I do want to also point out and provide insight into the average megawatts sold on the transmission side. The rate case assumed sales of a little over 36,000 average megawatts of our network product, and we ended the year roughly 750 average megawatts, or 2% short of that assumption. The rate case also assumed intertie product sales of 6,098 average megawatts, with actuals ending the year slightly above rate case at 6,103 average megawatts sold. So in total for net revenue, lower total expenses for transmission driven by lower non-IPR expenses and lower revenues have resulted in end-of-year transmission net revenue of $3 million, which is $34 million better than our rate case projection. So moving to slide 11, this agency balance sheet overview is a slide we're including for the first time today. I think it's important to walk through a snapshot of our financial position compared to last year in key areas like cash, utility plant, which reflects our capital investments, regulatory assets, and debt. You'll notice that the most dramatic change was in cash and cash equivalents, which increased $361 million or 43% in fiscal year 21. But it's important to remember that cash is different than reserves. To get to reserves, we adjust for cash held by our generating partners and also deferred borrowing. The increase in our cash was driven by $1.147 billion of cash provided by operating activities in fiscal year 21, such as sales of our power and transmission services, less our operating expenses. The $1.147 billion of cash provided by operating activities was offset by $619 million from cash used for investing activities, mostly to construct utility plant assets, and $168 million from cash used for financing. The cash used for financing consists of net borrowing and repayment from our debt activity throughout the fiscal year. The net utility plant, which consists of completed plant capital investments, construction work in progress less annual depreciation, increased approximately 1%, which was a total change of $200 million when compared to fiscal year 20. This increase was primarily driven by a $192 million increase to construction work in progress, consisting of $130 million for transmission, $58 million for hydropower generating assets, and $3 million for other assets. The regulatory assets decreased by $237 million over the year, which was a 5% change from fiscal year 20. This reduction was driven by several factors, including amortization of existing regulatory assets, such as residential exchange benefits, terminated nuclear facilities, and fish and wildlife measures. Consistent with 2020, this amortization expense exceeded new additions to regulatory assets. Partially offsetting this decrease was an increase to regulatory assets for derivative instruments of $62 million and an increase for Columbia River fish mitigation study costs of $26 million. In our BP22 rate period and going forward, we will no longer be treating CRFM study costs as regulatory assets. They will be expensed annually on the income statement. And last, total debt, which includes both long and short-term debt, increased by approximately $102 million when compared to fiscal year 20, primarily to fund utility plant investments as discussed previously. This was a 1% change overall, and I'll spend the next couple slides highlighting key debt trends by business line. So moving to slide 12, Power continued its trend of being an overall net debt repair, a trend I expect to continue into the future. It ended fiscal year 21 with $6 million less debt outstanding compared to fiscal year 20. Power's debt to asset ratio decreased slightly compared to fiscal year 20, ending fiscal year 21 at 88.2% compared to 88.7% at the end of the prior year, a 0.5 percentage decline year over year. I also expect this trend of deleveraging to continue for Power. So looking at the graph, the most significant thing that stands out is the effect of the Regional Cooperation Debt Program that concluded in fiscal year 20, which focused on extending maturing regional cooperation debt bonds and using the proceeds to pay a like amount of appropriations, thereby significantly reducing the amount of appropriations outstanding. Fiscal year 21 saw quite a bit of debt activity for Power. With Energy Northwest, we issued $712 million in bonds for the first Regional Cooperation Debt 2 transaction, New Columbia Capital, fuel, and refinancing for savings. This enabled $332 million of additional federal bond repayment, which restored borrowing authority. Our net activity for U.S. Treasury bonds saw a $204 million decrease in the amount outstanding, largely driven by the Regional Cooperation Debt 2 program. We'll continue to see this pattern repeat as the Regional Cooperation Debt 2 program plays out. With regard to appropriations, between repayment and new additions, there was an overall net increase in appropriations outstanding of $59 million, and the Power Prepay Program, which will continue to amortize off through 2028. Fiscal year 21 amortization was $22 million. So moving to slide 13, Transmission continued with its trend of being an overall net borrower, adding to its total debt balance. Transmission ended fiscal year 21 with $108 million more debt outstanding compared to the end of fiscal year 20. Despite this, Transmission's debt to asset ratio decreased because of investments in utility plant. Transmission ended fiscal year 21 with a debt to asset ratio of 76.8%. Compared to 78.1% at the end of fiscal year 20. This is one of the key reasons we want to re-engage on the financial plan. It's great news to see Transmission's debt to asset ratio decrease, but it's concerning to see its total debt continue to climb. This is one of the main focus areas in the financial plan refresh to further explore sustainable capital funding and debt management practices. In terms of fiscal year 21 debt activity for Transmission, we had 2 non-federal lease purchase long-term takeout transactions totaling $511 million and repayment of $78 million of maturing lease purchase bonds, resulting in a net reduction in lease purchase obligations of $60 million. For U.S. Treasury bonds, Transmission saw the outstanding amount increase by $184 million. So now turning to our capital program on slide 14. Our fiscal year 21 results for total capital expenditure is $680 million, which is $172 million below rate case. Looking at Power capital specifically, we ended $73 million below the rate case forecast. Of that, the Fed Hydro Asset Program underspent by $71 million. This is due to a few factors, such as reprioritized projects that resulted in fewer Bureau of Reclamation projects and more U.S. Army Corps of Engineer projects moving forward. The gap created by canceled and reprioritized Bureau project was only partially filled with Corps projects. The Corps and Reclamation are both still working to ramp up project execution to match plan targets. So turning to Transmission capital, we ended $103 million below the rate case forecast of $516 million. The drivers are spread across a few of the subcategories within the total Transmission capital budget. First, the combined sustain and expand spending ended just $22 million below rate case due to COVID and other resource constraints across pretty much all of the functional areas. In addition, customer-funded projects, also called PFIA, ended $50 million below rate case due to customers requesting to delay or cancel projects, as well as COVID contracting delays. Other asset categories within the transmission spending forecast are $31 million below rate case, mainly due to a reprioritization which focused on additional scoping and design work of the technical services building and the continued scoping of the Vancouver Control Center project instead of projects that would have been in construction. So we continue to maintain our focus on our capital project execution, which is another key area of the financial plan refresh. Using the secondary capacity model, transmission has initiated 2 task orders for a total of 18 projects. The 3rd task order is underway for an additional 11 projects. The first task order has moved out of scoping and into design, with construction activities expected to begin in the middle of fiscal year 23. We'll be diving into more detail on these metrics in this afternoon's QBR technical workshop and the upcoming financial plan refresh workshops. So moving to Fish and Wildlife capital ended $5 million below rate case due to hatchery delays and fish passage project delays. This was partially offset by higher land spending as a result of a stewardship agreement with the Confederated Salish Kootenai tribe in September. And finally, corporate capital spending ended $10 million above rate case due to prioritization of corporate IT and grid mod projects. This also includes other projects qualifying for capital when they were originally forecast as expense due to changes in our accounting treatment for cloud computing solutions. So the last financial area I'll turn to is financial reserves. Agency financial reserves for risk ended the year at $825 million, an increase in reserves of $118 million over the prior year. Power financial reserves for risk increased $182 million from $435 million at the end of fiscal year 20 to $617 million at the end of fiscal year 21. And transmission financial reserves decreased $63 million from $272 million at the end of fiscal year 20 to $209 million at the end of fiscal year 21. But recall that for transmission, an RDC was triggered last year, resulting in $80 million additional debt repayment above what was planned in the rate case. So the agency and power reserves for risk are both above the reserves distribution clause or RDC thresholds, and the RDC amount is greater than $5 million, which means the RDC is triggered for power. The RDC amount is approximately $14 million for power, and this is a result of strong fourth quarter performance with robust revenues and disciplined cost management throughout the year. And as John mentioned earlier, he's reached a preliminary decision to apply the entire $14 million towards rate reduction in fiscal year 22. We are very pleased to have healthy reserve levels that enable this distribution and to be on a financial trajectory with power that makes a power rate reduction the right thing to do for BPA and the region. We will be discussing the RDC in more detail at this afternoon's QBR technical workshop, so please make sure to listen in. Transmission's reserves for risk also finished above the RDC threshold. However, because the results are not $5 million or more above the threshold, the RDC did not trigger. While no action will be taken for transmission, it's still great to see that they are also in a very healthy reserves position to start fiscal year 22. And looking at days cash on hand, which is a key financial plan performance metric, the agency is at 130 days cash on hand, power is at 134, and transmission is at 121. And 120 days on hand is what sets the upper threshold for the RDC. So just a couple final updates from me. First, our credit ratings remain very strong with all 3 rating agencies being unchanged from the prior quarter. Moody's is at AA2, Standard & Poor's is at AA-, and Fitch is at AA. We expect to get new ratings in the April to May timeframe in advance of the spring 2022 Energy Northwest transaction. And with regard to the financial plan refresh, we very much appreciated your engagement so far as we've kicked off this important initiative and held 3 grounding sessions. And just last week, we had a robust discussion about the role of depreciation in our rate structure and how our repayment model works. We look forward to starting calendar year 2022 with focused sessions on debt and borrowing authority and capital investment prioritization. And speaking of borrowing authority, and as John mentioned earlier, I want to highlight our appreciation for the $10 billion in additional borrowing authority that was included in the bipartisan infrastructure deal that President Biden signed into law. This is a powerful financial tool that goes a long way to resolve our access to capital challenges for at least the next decade, providing very low cost and predictable funding for our ongoing capital program. It's important to remember, though, that we still have work to do to ensure our debt management practices are prudent, including managing to healthy debt levels. And I look forward to partnering with you and the rest of our customers in our financial plan refresh to find long-term sustainable solutions in this area. And finally, as a reminder, we have our QVR technical workshop this afternoon from 1 to 3. We will discuss more details of our fiscal year 21 financial performance, including a deep dive on the reserves distribution clause mechanism for power and transmission, and sharing updates on grid modernization projects. I will now turn it back over to John to touch on some of the activities happening at Bonneville. John?
All right, thanks a lot, Marcus. And as you can see, Marcus covered a lot of ground, but the financial results were very strong for us this year. Now, in a minute, I'll cover some of the other highlights of fiscal year 2021. But first, let me share an update on the federal vaccine mandate and how it's impacting our workforce. As an element of the Department of Energy, we are subject to the presidential executive order requiring the federal workforce to be fully vaccinated by November 22nd. And we are complying with that lawful order. Now, currently, we have about 86.2% of our workforce who have achieved full vaccination, and that number continues to climb. Now, the majority of our employees who have not been vaccinated are actively going through a reasonable accommodation process. We are working with the Department of Energy to ensure a fair and consistent approach to reviewing those requests, and will work diligently to bring them to closure fairly soon. Now, our contract workforce also falls under a federal mandate for vaccination, and the timeline with contractors is slightly different and will be driven through contract modifications. Now, ultimately, whether we're talking about contractors or federal employees, BPA's interest is preserving the safety of our workforce and our ability to maintain our mission. Now, we'll continue to track this situation closely, and we have plans and tools in place to ensure that BPA continues to meet our mission to deliver power reliably and safely, and to maintain our commitments to our customers. Now, I'd also like to remind you that we recently stood up a Workforce and Strategy Office with Dan James as our Chief Workforce and Strategy Officer. And one of the reasons we created this office is to place greater leadership emphasis on people and culture issues. Now, BPA's entire leadership team is committed to supporting our workforce and ensuring we continue to grow the workforce culture we've worked so hard to advance in recent years. Now, this is critically important, and we know BPA is only as good as the people who make up our organization, so taking care of them is a priority and something that we'll continually work at. Now, moving on to our strategic goals, we've made great progress in fiscal year 21. Now, among the highlights under our efforts to modernize assets and system operations was our decision to join the Western Energy Imbalance Market. Now, it's clear that our grid mod efforts have taken root, and we are laying the foundation for enhanced revenue opportunities, operational benefits, and efficiency. Now, we remain on track to join the EIM in March of 2022, and we're currently in market simulation testing, and in December we'll begin parallel operation testing, which means we'll be able to test our systems in a simulated environment. We also recently updated the EIM Customer Impact Summary that documents all of the changes customers can expect to see under the EIM. That's a great resource if you have questions, and we'll continue to keep you engaged through a series of EIM implementation workshops. We are planning the next workshop, and we'll share details on our EIM webpage when we do get that date finalized in more details. Now, also in Q4, we decided to participate in the next phase of the Northwest Resource Adequacy Program. Now, the idea is to provide planning transparency across a larger footprint, and it could bolster grid reliability, enable greater efficiencies, and potentially reduce costs for the region's utilities and ratepayers. In the current non-binding phase, members are providing capacity data to show how they are meeting the program's resource adequacy standard. Now, we'll continue to keep you involved, especially when it comes time to determine whether BPA should participate in the final binding phase of the program. We've held our first public meeting November 19th and presented our plan for consistent engagement throughout the phase, so that way we can share what we've learned with customers. We expect to conduct the public process and to make the decision about participating in the binding program in the first quarter of fiscal year 23, if current program timelines hold. Now I'll move on to our focus on providing competitive power products and services, starting with an update on our Provider of Choice initiative. Now this is in regard to the future long-term power contracts following the expiration of our current contracts in 2028. Now, I want you to know that everything BPA is doing to strengthen finances and maintain competitiveness is driven by our desire to fully subscribe the firm power of the FCRPS to our preference customers. We've been doing a lot of outreach and listening through our Provider of Choice effort to lay the foundation for our policies and contracts that we'll offer into the future. Now, we were planning to release a concept paper by the end of 2021 to outline BPA's vision for the future contracts. But based on customer feedback, we are adjusting the schedule to support customer-to-customer engagements. Now, I really hope that this will expedite customer alignment, and we will adapt our work plans in recognition of a firm March 2022 joint public power concept paper release. Now, our preliminary goal is to make sure that we get this information from our customers and be able to factor it into our long-term discussions. And we're looking at being able to post our post-2028 initiative in designing a contract to offer and to meet our customer needs, and we look forward to continuing collaboration on this effort. Now, I'll shift to the recent agreement we negotiated for short-term power operations, leading to the pause in litigation over the Columbia River system operations. Now, in my view, this agreement recognizes the delicate balance that BPA and our federal partners are responsible to achieve as stewards of the Columbia River system. Now, the stay will provide us with operational certainty for 2022 operations. It also mitigates the cost exposure of the preliminary injunction measures, which I tell you could have resulted in significant upward rate pressure. Now, the operations under the stay agreement reduces federal generation on an average of about 45 megawatts. Now, BPA's priority is to ensure that public power customers do not bear the cost of the stay agreement operations, and we will do our best to absorb the cost of the operations within our BP22 spending levels. The state also creates room for broader discussions between the administration and plaintiffs on potential long-term solutions to resolve the litigation. Now, at this point, no agreement has been made on the scope of those discussions, but the administration is committed to evaluating alternatives and looking at anything that we can do a little different to the current approaches. Now, I look forward to considering long-term solutions to restore salmon, honor our commitments to tribal nations, ensure reliability, affordable, clean energy, manage flood risk, and to meet the region's economic needs. So more to come on that process, but it was a very important step in us being able to negotiate, I think, a positive settlement, although the preferable path obviously would be to stay on the course of the preferred alternative. Now, moving on to transmission, I want to point back to our fiscal year 21 results. And considering the year we had with severe cold temperatures, a heat dome, and widespread wildfires, I'm incredibly proud of our transmission reliability. Now, our wildfire mitigation plan, I feel, contributed greatly to our strong performance, and we're committed to building on it based on what we've learned so far. So we're working on a summary of the 2021 wildfire season that we intend to share in the coming weeks. But that said, as I mentioned earlier, I am tremendously proud of our field operations crew, as well as our operations team, and how they've been able to handle these severe conditions and maintain reliability for the region. Now, to further support reliability going forward, we are devoting capital to 2 facility projects this year. The first is the new transmission services building, which will mainly serve the teams that ensure reliable operations of BPA's communication and control networks. These teams are central to the agency's ability to maintain power system stability and return the system to service after a major disruption. This project will also offer long-term cost savings by avoiding growing maintenance costs of the existing World War II era buildings and enabling the elimination of leased space. Now, we expect to complete the facility construction in the summer of 2023 with operations beginning in the fall of 2023. Now, we're also proceeding with plans to replace the existing Dittmer Control Center, which was built in 1974. Now, you might recall that the new Vancouver Control Center was a topic at the Integrated Program Review 2 we held in March. Now, based on customer feedback, we reduced the amount we intend to spend on this project in fiscal year 22 from $37 million to about $12 million. Now, the new VCC is needed to improve life safety, improve physical and information security, and to adopt emerging technologies. We'll be hosting a customer meeting on Tuesday, December 14th from 9 to 11 to provide an update on the Control Center project. And we look forward to being able to share that information with you and really just talk about what we feel the future of our technological needs will be. Now, that wraps up the state of the business review, and I'll now hand it back over to Joel Struggs.
All right. Thank you, John and Marcus. Now I'm going to highlight some of our upcoming meetings and processes over the next month. As a reminder, all of our customer and public meetings are listed on our event calendar at bpa.gov. And following those reminders, we will open it up for Q&A. As Marcus mentioned earlier, we're hosting the QBR Technical Workshop for Q4 this afternoon from 1 to 3 p.m. We encourage you to participate in this workshop where our finance team will provide additional information on some of the topics discussed today. You can find more info about the QBR Technical Workshop on our QBR webpage at bpa.gov/go/QBR. Next Tuesday, November 30th from 9 to 11 a.m., we're holding a meeting to discuss Clark Public Utilities' request for the administrator's consent to partially discontinue its River Road gas plant. Looking at December, we have a long-term available transfer capability and transmission integrated planning customer workshop on December 7th from 9 a.m. to noon. On December 14th from 9 to 11 a.m., we're hosting a public workshop on our Vancouver Control Center project, which was just mentioned. This virtual workshop is an opportunity for us to provide customers and stakeholders with information about the rationale for the VCC project and to answer your questions. We'll also go over the internal approval process and anticipated timelines. The next commercial business process improvement customer conference call is set for December 15th from 10:30 to 11:30 a.m. And there's a financial plan refresh workshop on Wednesday, January 12th from 1 to 5 p.m. Now let's take a look at our active comment periods. We have 3 public comment periods going on right now. The comment period for our Resource Adequacy Phase 3A Engagement Workshop closes Friday, December 3rd. The comment period for how to redistribute the reserves distribution clause for power, which both John and Marcus touched on earlier, closes on Wednesday, December 8th. I'm told that this comment period will appear on our website later today. And the composite cost pool true-up and slice true-up adjustment public comment period closes on Thursday, December 9th. We invite your comments on these items and processes. As a reminder, you can view public comment periods and submit your comments on the public comment section of our website at bpa.gov/comments. All right, we just electronically released our FY21 annual report, which is titled Shaping the Future of Clean Energy. This high-quality publication captures our operational and financial performance from 2021. Kudos to our finance and communications teams for delivering another spectacular report. It's worth mentioning that the Northwest Public Power Association recognized our 2020 annual report with an Excellence in Communication Award, and we're equally proud of this one. I do hope to get an autographed copy from both of you gentlemen at some point. You can read and download a copy of the annual report from our website at bpa.gov/finance/financial information/annual reports. Or more easily, you can just find the FY21 financial success story on our homepage and follow the link. All right, that concludes the presentation portion of today. We'll now transition over to our brief question and answer session. Let's see if any questions have come in. Do we have any to this point, folks? I know there's a bit of a delay sometimes.
No questions have come in.
Okay. Well, I think we can wrap things up. If you do think of a question later or would prefer to email it, you can email us at communications@bpa.gov. If we do receive some incoming questions via email, we'll be posting those follow-up answers on our QBR webpage in the coming weeks, along with a recording and a transcript of today's meeting. And if you have a topic that you think warrants further discussion, you can also reach out to us by emailing communications@bpa.gov, and we will look at the best way to get that information to you or consider setting up a meeting. Finally, thank you for joining us today. We really appreciate you engaging with us in this forum and others. Our next QBR will be in February, where we will recap the first quarter of fiscal year 2022. We will announce a specific date for the Q1 QBR at a later date. Thanks again, and have a safe and healthy and restful Thanksgiving.